Luna with Century 21 C. Watson, and today I'm going to talk about the two questions we continue to hear again and again in the world of real estate. Is this a bubble? And if so, when will it pop? First, let's start with whether or not we are currently in a bubble. What does that mean? A real estate bubble is a run-up in housing prices fueled by demand, speculation, and exuberant spending to the point of collapse, also known as a bubble burst or pop. There are 5 stages to a bubble: displacement, boom, euphoria, profit-taking, and finally panic. Right now we're seeing stage 1 and 2, and some of the hottest markets are seeing stage 3. Stage 4 in the bubble is profit-taking, and that is some in the market see the value as over market, so they begin selling to capture profit. However, everyone needs a home to live in. Whether people are selling to upgrade, downsize, move into retirement, or even just make a lateral move into a new area, chances are they're still going to need some sort of home. Step 5 is the one everyone is most scared of: panic. Investors move quickly to liquidate and asset prices begin to drop. Sometimes they drop as rapidly as they rose. However, there is so much pent-up demand, and there were several years with a shortage of new home building. Right now, competition is fierce. There is very little inventory and lots of buyers. Time and time again, we're hearing parallels to 2006, meaning even if we see some of stage 4 profit taking, there is enough pent-up demand to absorb and keep from escalating to stage 5, panic. Not every economic boom is a bubble. The overall economy moves in a boom and bust cycle. That's normal and to be expected. An industry or commodity increases in value and then decreases. However, what makes this different than what we saw in the 2000s is that in the 2000s, poor lending practices created a shaky foundation for the housing market. These changes in market value are based on solid underlying fundamentals of supply and demand. The prevailing assumption was that real estate was an unquestionably safe bet. There was only one way it was going, and that was up. Some of the practices that created the shaky foundation included low to no down payment financing, meaning that many homeowners had little to no equity. Ninja loans, also known as liar loans, took stated income and required no documentation during the underwriting process. Adjustable mortgage rates created a situation where homeowners might get stuck with skyrocketing interest rates and a mortgage payment they simply couldn't afford. We've learned a lot since then, and lending practices have tightened up considerably. Documentation, credit score requirements, and strong loan-to-value ratios mean that homeowners are well positioned to afford the home they currently own. In addition, homeowners have much more equity. Even financially strained homeowners can sell and walk away with equity in their pocket before getting foreclosed on. The pandemic created a fundamental shift in demand. We have spent more time in our homes this past year than any other time in history. Many homeowners decided they either loved their home and invested in ways to make it better, or they wanted something different. Whether they're looking for more room to spread out in the suburbs or rural areas, buyers with solid flexible jobs spent less last year eating out and on vacation and now have cash readily available to deploy on housing. Or as we've seen here in the Central Valley, people from larger cities such as the Bay Area realize that they can work remotely. So they've decided to leave expensive apartments and move to areas where they can afford more space for their money. So after the past year of being cooped up, buyers have a desire to move, are flush with an excess of cash, and want to capture ultra-low interest rates. A bubble happens when the current market value increases beyond those fundamentals. And the current market conditions point to an organic pandemic-related market growth, rather than an artificially fueled real estate bubble.